Welcome to the AACFB's 2022 Meet the Funder webinar series. My name is Monica Harper. I'm the Executive Director of the AACFB, and I'll be your host. Our presenters today are Casey Estrada and Kush Kakaya from Founders First Capital Partners. Founders First Capital Partners is both a funding source member and a bronze sponsor of the AACFB, and I'd like to thank them for their support of the association. Before I turn it over to them, I'd like to go over a few items to make this webinar more enjoyable and informative for everyone. During the presentation, you should see a Q&A box that will allow you to ask questions. If you have any questions during the presentation, please submit your question in the box and they should be answered by the end of the webinar. The entire webinar should take no more than about 30 to 45 minutes. For those of you who would like to review this webinar later at a later date, it will be posted on the 2022 Meet the Funder webinar page, and it will be emailed out to the AACFB membership. At this time, I'll turn over to Tracy, and she will introduce you to Kush and Casey. It's all yours.
Hello. Thank you, everyone, and thank you, Monica. We're super excited to co-host our second webinar with the AACFB. This one is going to be a little bit different than our last one. So it's everything you need to know about Founders First and revenue-based financing. We're going to have a little kind of a Q&A setup for this webinar. After the fact, we will send an email to everyone that's registered for our webinar. So you'll get the slides, so that way you can kind of have them for safekeeping. And now I will turn it over to Kush Kakaya and Casey Estrada to kick off our webinar. Thanks, everyone.
Wonderful. Thank you so much, Tracy and Monica. I really appreciate you guys having us here. My name, as Tracy mentioned, my name is Kush Kakaya. I'm the Business Development Officer here at Founders First Capital Partners, and I will pass it over to Casey.
Hi, everybody. I'm Casey Estrada, Director of Investments here at Founders First. Probably have met a number of you as I was in attendance with the conference a couple months ago down in Vegas. So, looking forward to continuing some of the conversations we had since the conference, as well as hopefully getting some deals done here with you through our funding programs.
Amazing. All right, and with that, we'll get started with our webinar. So firstly, would love to just, this is going to be more so of a conversation type of webinar that we have, but wanted to just give you guys a little bit of a brief overview as to our company. So firstly, Casey, just who are we, and what do we do, and what do we offer?
Yeah, so Founders First, we are a mission-driven organization, and really our goal is to add high-quality jobs in the marketplace by supporting businesses that struggle due to racial or socioeconomic gaps within the small business communities. So we focus on helping businesses that are run by women, minorities, veterans, as well as those located in or servicing low to moderate income areas. So that's kind of really where we focus most of our programs and our funding and things like that. So outside of just funding businesses and providing direct access to capital, we also provide education and mentorship via accelerator programs. And then of course, the main one here is the direct access to capital through revenue-based financing and term loans. So specifically, our market is diverse-led businesses with annual incomes ranging from $500,000 and upwards. We're looking for businesses that function in the B2B space, relatively industry agnostic, but our funding programs are geared towards businesses that have predictable, recurring or contracted revenue streams.
Amazing. So I know a few of the brokers here might be familiar with revenue-based financing, but for those of you who aren't, Casey, why don't you just give us a little bit of an overview of what revenue-based financing is, and what the differences are compared to some of our other alternative funders, such as merchant cash advances or factoring.
Yeah, definitely. So, revenue-based financing, it definitely has its place on the funding spectrum. Specifically, it's revenue-based financing for a couple of reasons. One, the amount we can provide is tied to revenue levels of the business. So part of our model is to grow with companies as they continue to scale. So our goal is to be a long-term capital provider, hold those relationships, And then of course, on the broker side, continue to pay out as we continue to do deals, follow on deals there. The second piece of revenue-based financing is the payback mechanism. So, we do offer a term loan where it's a fixed dollar amount monthly payment, but with revenue-based financing, the monthly payment scales with the cash flow of the business. So it works well for businesses that have seasonality or maybe lumpy collection cycles or long collection cycles. Essentially, instead of taking a fixed dollar amount, what we're doing is taking a fixed single-digit percentage of the customer sales that are hitting the bank account from the previous month. So it kind of mirrors the ebbs and flows of the business. As far as where we sit, so we're working with non-asset or asset-light businesses, businesses that would traditionally struggle to get any type of bank financing, especially a bank loan. And we're not like the short-term options such as like a finance or a factoring line or a merchant cash advance. The difference there is we're really structured as a term loan and secured by UCC1 on the business.
Sweet.
And this just kind of shows the differences here. So again, we're not requiring or purchasing invoices or future revenues of the business, unlike factoring or merchant cash advance. It's solely secured by the business itself, just like any traditional term loan.
Wonderful. And then Casey, we also added a question in the chat. Is $500K the hard floor on our revenue requirement?
Relatively hard floor. And the reason for that is because the amount we can provide is a ratio based off of revenue. 500K is kind of the minimum, and that's because the smallest check we'll write is 50K. So businesses that are lower than 500K typically struggle for us to get up to that 50K marker. The other requirement I would also note is that we do require business is generating revenue for at least 12 months.
Great to hear. And then we also had one other question. Will we finance for-profit schools?
Yes, yeah, we're looking at entities and organizations that are generating revenue. So as long as they're meeting those revenue requirements, that's certainly something we can look for. Predictability of revenue is a big piece of what we're looking for. I can only imagine that schools are relatively predictable.
Wonderful. All right, off to the next slide. So what is kind of our what would you say is the thing that honestly just makes us different from other from venture capital or other asset-based lending that is out here in the space?
Yeah, so unlike some of these other alternative lending options that we discussed, like factoring and MCAs, on the other side are equity investors, and we're 100% non-dilutive. Companies don't have to give up a piece of the pie to work with us. So that's probably the biggest piece. And of course, with that comes like no loss control. So we're not controlling a board seat or anything like that. And businesses don't have to pledge any specific assets and specifically personal assets. We're not asking for personal collateral here. So we just want to stress that our loans are secured by just a standard UCC1 on the business. Outside of that, like some equity investors, we do provide strategic advisory services as well. So there is, that option and that upside that comes with working with Founders First. Yeah, I think that probably answered the question. I don't know, Kush, if you want me to dig in anything deeper there.
No, I thought that was perfect.
Good.
Amazing. And so I know we touched on kind of the revenue requirements that we have for some of our businesses, but I was wondering if you could go into depth on some of the some of the qualifications for our revenue-based financing and term loans.
Yeah, definitely. So we talked about the revenue requirement and the time and business requirement. Again, that's going to be minimum 500K, 12 months in business. More typically would be, $1 million in revenue with 24 months in business. And the reason is because, we want to see these cycles play out. So we need at least one cycle that helps us understand the seasonality and project out, what the business would look like through the term of our loan. And then, ideally they're meeting one of our diversity requirements, whether that's women owned, veteran owned, diversity owned, LGBTQA, or companies that are located in or serving low to moderate income areas. So relatively diverse definition of diversity, but we are able to lend to basically virtually all U.S. based businesses as well. So let's always willing to have those conversations as they come through. And then we're looking for businesses that aren't necessarily profitable, but are on some type of pathway to profitability. We know that there are businesses out there, they may be on a longer trajectory where they're burning some cash, but we can see that they profitability is right around the corner. So we wouldn't exclude a business just because it's not profitable at this point. And then the big piece really is the recurring or predictable nature of the business. So things like annual contracts or recurring contracts, subscription-based businesses, I think B2B tech or SaaS, those all work very well. Ongoing services work well for us too. B2C, direct to consumer, retail can be tough for us just because of the lack of predictability there. Trying to think what else should I cover here? Kush, you got any suggestions?
No suggestions for right now, but I did have we did have a pretty important question in the comments. Would churches qualify for any of our financing options?
Yeah, we wouldn't disqualify a church. Again, it really just depends on if they're generating enough revenue and they've got that predictability piece. So happy to take a look, and we'll share our contact information later so we can start some of these conversations one-on-one.
Wonderful. Amazing. All right.
Oh, and just to kind of touch base, so to highlight some of the industries we don't work with, we are relatively industry agnostic, but some of the businesses we aren't working with, we can't work with cannabis at this point. Weapon manufacturers or ammo manufacturers, gambling, liquor industry, and then businesses that work best really are going to be those asset light or service-based companies, long-term contracts, recurring revenue, and specifically, software as a service or tech-enabled or tech-focused companies are good fits. Typically, they're not going to have any assets there to collateralize. So, we tend to be better options for those types of businesses than say, bank lenders.
Got it. And then we also did have one question in the comments as well. Do you finance revenue-based vending machines?
Revenue-based vending machine. I would be interested to learn more. Yeah. So let's talk. We'll send out our emails so we can specifically learn more about those businesses.
Amazing. All right. And this is obviously an extremely important question, but how much will revenue-based financing cost all of these clients?
Yeah, we're just looking for a capped return. It's fixed. So really when that cap is hit, the loan is repaid. Remember, the monthly payment is flexible. So we may target, for example, a 36-month maturity, but it might take the company an additional 3 to 6 months to pay us off, and that's fine. There's no balloon payment, there's no penalty for that. It just takes a little bit longer. So we try to be really good about modeling these out, but essentially the loan is repaid when the cap is hit. So a good example here is if we gave a $100,000 or $200,000 loan, and we took a 2% royalty on their monthly revenues as a repayment mechanism, that loan would be repaid when they hit a 1.3x cap in this example. So call it $260,000 return to founders on $200,000 in principal. that one would be modeled on a 3-year term.
Wonderful. And then we did also have another question that might actually be perfect for this section, but what is the approximate formula for how much a borrower can obtain based upon sales?
Yeah, I'll give a range here, and there's a number of factors that go into the specific amount, but generally speaking, we can give 15 to 25% of the trailing 12 months revenue, and then of course depending on things like their margins, their growth, the predictability of the revenue. So split the difference there, call it 20%. So business is doing $1 million over the last 12 months, we could look to do 200,000, maybe up to 250,000.
Amazing. And then one last question as well. Is 10% of the revenue the model to determine the loan amount? It's from Mark Sheehan.
Got it. Yeah, so that's kind of a follow-up to the previous one. 10% is a little bit on the low end, maybe if we're doing a shorter term loan. But in general, I'd say 15 to 25%. So for like a 2 or 3 year loan.
And then what would repayment look like from a term loan specifically?
So yeah, this is the second product we offer. We're underwriting these things the same way. We're sizing these things the same way. We're targeting the same term length. The only difference is the payback mechanism. So it's going to be a fixed dollar amount, fully amortizing over the term of the loan. It's just going to be that fixed dollar amount instead of the flexible revenue base. This works better for companies that aren't as predictable in their revenue streams. So maybe it's more transactional in nature. Maybe they're working with the same customers, but their sales are more project based. So rather than like a fixed annual fee or something like that, they're paid on a per project basis. Term loans a good option for those businesses.
Awesome. And then I did also have one question for myself, but is there any opportunities that any of their clients could get, also get, a revenue-based financing loan as well as also a term loan?
Yes. Yeah. So, there are certain businesses that might qualify for revenue-based financing, but they, would prefer the predictable nature of a term loan payment. We can do either or for those types of businesses. I think, is that what you're asking, Kush? Or
yeah.
Okay. Yeah, definitely. Yeah. So we can look at both structures depending on the type of business, that's applying.
Amazing. And so in order for a company to get qualified from us or to get under the initial review, what documents will we need to get started?
Yeah, this is a good one, and of course, for our brokers and referral partners out there, this is the one that we really try to make sure you all come away with is our underwriting is really unique to our product. Revenue-based financing really relies on the monthly trends, right? Like if we're going to take a flexible monthly payment based off of customer revenue and monthly cash flow, well, we need to see those monthly trends. And so we're looking at monthly financial statements or historical monthly statements for a business. Typically, we want to see the past 24 months. We do need to see those in Excel. That's just how we manipulate data would be within Excel. So getting those over to us in Excel is important. Revenue by customer is important. This really goes back to the predictability of the revenue. So we want to see who not necessarily who their customers are, but how many they are, if there are any concentration concerns, things like that. And then a debt schedule. Obviously, we're evaluating cash flow and debt service coverage of these businesses. So if there is any debt, and by the way, we do clean up a lot of debt on balance sheets. So think of that as a good use of funds as well. We just want to understand what those terms are. There are some debt providers that we can work with and sit junior to. Those are going to be your banks, credit unions, for example. But other types of lenders we would want to take out, so alternative lenders and other types of players out there. And then projections, if available, that just helps us model out our cash flow style payments. We know not all businesses are going to be generating or producing projections. So it's not a requirement, it's more of a nice to have. And then timeline, I always say, hey, once we get our initial documents, takes us 2 to 3 weeks to close a deal. We can get a term sheet out within 3 to 5 days after reviewing the initial documents, and then the rest of that time is really just back and forth, maybe some light diligence, and then closing process. Of course, takes a little bit.
Wonderful. And then I also just wanted to, reiterate one thing that you said, Casey. For a lot of, for our underwriting process, we have a very strict requirement of having all of our financial statements be put into Excel. So a lot of the times, a lot of your clients might be sending over some of your financial documents, balance sheets, P&Ls via PDF. Unfortunately, just so that I wanted to let all of you guys know, that's not something that we can process on our end. We actually have to have all of our financial documents within Excel for us to be able to provide all the data to our underwriting team. It's just, it might be an extra step for all of you guys and maybe for your client, but from a compliance standpoint, we need to ensure that all of the data is in Excel for us to be able to process it. So that's
there is one exception I want to point out. So we have built out an API with QuickBooks through a third-party data provider, Codat. So if any of your clients are using QuickBooks, they can just sync their accounts with our systems, and we can pull the relevant reports. Super easy. It's like a 30-second process. So that's always a good option. And I did want to, looks like Mark threw a question in the chat here. Is the lowest amount you finance 50K? What if someone wants 35K but qualifies for much larger? So 50K is the smallest check that we'll write. But the second part of your question, if I qualify somebody for $1 million, but they only have use of funds for 200K, well, yeah, we'll write a check for 200K. What's great there is they understand though that they've got line of sight to another 800,000. And to that point too, so just the largest loan that we'll do on a first tranche is $1 million. We can go up to 2 million per borrower, but of course we want to make sure that these companies are deploying the capital efficiently. So if they need less than they qualify for, so long as it's over 50K, we'll do that.
Amazing. And then we got another question from Bill. For companies that are using a different system that is not Excel, how much does it cost for them to convert it to Excel?
Yeah, that's that's going to be a question for the business to work out with their bookkeeper or accountant. We are starting to offer some financial services to businesses that may not have or may have some type of accounting needs. But we're happy to figure that out on a case-by-case basis. I would say again, if they're not using QuickBooks and don't want to sync with our system, the requirement there is that we get those docs in Excel.
Yes. And then also to follow up on Casey's point, regarding exactly the formatting process of, collecting the documents and the data, we actually have compiled, a few different templates. So that we have in our format that our underwriting team likes to have. So what I can do is for any of you guys who do have any clients that you want to send over to us, I'll go ahead and I will send over the templates so that you can forward them to your clients. Got it.
Hey, yeah, that's perfect. And we'll make sure we send those out as we start these conversations. Coach, let's flip over to. Oh, okay, yeah, we got a couple more slides here, I guess. Huh?
We do. So why should we? Why? What makes us, different than other lenders out there? I think that's a very, very important question to ask.
Definitely. Hey, we're mission driven. I mean, look, we want to get deals done too, but at the end of the day, we're helping businesses that are underserved. So here's some stats for you. 600 plus companies we work with. Of those, over 70 have increased revenues, over 60 have increased profits and added recurring revenue or made key hires. And then of those 600 plus companies, they're all increasing, or at least, over a third are increasing their average revenues by 34% here. So we are doing a lot of good work. If you've got businesses that are looking for growth opportunities outside of just access to capital. We do offer growth programs to businesses too. So if you know anyone who could be a good fit, happy to pass those on to our programs teams. So yeah, lots of good things we're doing for the small business community out there.
Amazing. And I guess that is the end of our webinar that we have. We also do have both Casey and I's contact information over here, and we've also provided the website as well. If you'd like to learn a little bit more so about our revenue based financing and term loan products. And we got 2 more questions from Mark. First one was, do you want oversight on how they're going to be spending their funds?
That's a good question. So it's pretty generalized. We want the money going towards growth, though working capital is fine too. Again, real broad, right? But as part of our servicing, we will be seeing financial statements. So what we don't want to see obviously is like we give $100,000 loan and on next month there's a Tesla that shows up on the balance sheet or something. So again, we want the money going towards the growth of the business.
Definitely. And then Mark, for your second question on how do the brokers get paid, we typically pay out 1%. So, when we do start having initial conversations with you and your client, we'll be sending over a broker referral agreement where we will be paying out 1% for each funded deal that we have. Casey mentioned that we're very, very mission driven. That's like our bottom line that we have, but also we want to respect the relationship that we build with brokers as well as your clients. So the rev share will be included in that broker agreement.
Yeah, I just want to add on to that too. We just work off of referrals. We do understand that these are your clients and you may have a process too, but hey, if you just make an intro to us over email, we'll link that client in our system, and you can be as hands-on or hands-off as you want. So, again, we're a full-service shop. We can do what we need to do to collect the docs we need. We'll underwrite the deal in-house. We'll handhold the client through that process. We even service our loans ourselves. So, again, I think what's important there, just feel free to be as hands-on or hands-off as you'd like.
Definitely. And then Mark had one last question. Thank you so much, Mark, for all of your wonderful questions. Really appreciate it. Do these loans need to be disclosed in California?
Hey, Mark, I'm not exactly sure what you mean there. All of our loans we do file UCC ones on all of the businesses we work with. So these loans are going to be on the books. If you had any specific questions or want to talk through further, feel free to reach out to me and we can talk about that.
Amazing. So I think we've actually, answered. There we go. Tim has got a question for us. Do we offer syndication / participation on referrals?
Tim, I don't know if I know exactly what you're asking for, but now if you're asking about partnerships or things of that nature, we're certainly open to different types of structures when it comes to partnerships or working together in a larger or more holistic way. We've got a team of business development people who are actively working on these. So feel free to come to us with any ideas or suggestions, and we very much welcome working with you on those.
Wonderful. These are all fantastic questions. Thank you guys so much for sending them over. And if you guys have any other questions, please feel free to post them in the chat box.
Hey, Kush, I actually
Yeah.
wanted to throw a question out there, kind of off of piggybacking. Are there any states where we can't work with a company or any restrictions?
Yeah. So you're all, I'm sure, familiar with some of the oddball usury laws and restriction out there. Just a few that are on our radar that we tend to either try to avoid or kind of change some of our requirements for. So Florida, we won't do deals that are smaller than 500K. So the business has to be considerably bigger than just that 500 or $1 million in annual revenue. Call it more like 3.5 million. In Texas, we won't do loans smaller than $250,000. Guess everything's bigger in Texas, but so that we would want to see at least $1 million in annual revenue. And then Nevada has their own set of usury restrictions that are hard for us because of our revenue-based model. So we just don't do any loans in Nevada.
And then what about for Hawaii and for Alaska as well, Casey?
Case by case there. I wouldn't put any blanket restrictions there, but we're certainly happy to look at Hawaii and Alaska based businesses as well.
Amazing.
Got it. Well, I think we're caught up on our questions here. That should be everything for us. Our contact information on the left side of the screen here. Feel free to reach out to me or Kush. I know some of you have already been in contact with us. So please just think of this as a refresher. We love to stay top of mind and love to work together just to, even if you have something that you feel might be a fit, feel free to run it by us. We're always happy to take a look.
Wonderful. Well, thank you guys. I want to say a big thank you to all our participants and especially our valued funding source and bronze sponsor, Founders First Capital Partner. And thanks for doing a great job. You guys fielded a lot of questions and I'm sure answered a lot of questions for everybody on this call. We will be recording this and posting it. So if anybody wants to watch it later, they can. Thanks again for joining us and have a great day.
Amazing.
Thanks, everybody.
Thanks, everyone. Have a great day.